everyone, welcome to Options Discovery on John Lothian News' The Spread. My name is Estem Awas, and I'll be your host throughout the series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In this episode, we'll be going over the effects of dividends and corporate actions, such as special dividends and stock splits on options prices. Later in the episode, my colleague Alex has a chance to sit down with Jordan Naylor, an industry veteran and CEO of Matrix Executions. Jordan will dive deeper into these concepts. Let's start this episode out by talking about the effects of dividends on options prices. For those who don't know, dividends are a payment declared by a company's board of directors to its shareholders. This payment comes from the company's current or retained earnings and usually comes in the form of a cash payment. The day the dividend is announced is called the declaration date. On this date, the board will usually set a cutoff period for which shareholders can receive the dividend. This is called the ex-dividend date. Any shareholder who bought the stock at or after the ex-dividend date is not eligible to receive a dividend. Cash dividends have an interesting effect on both stock and options prices. With all other factors remaining the same, a company's stock should experience a decrease in price that corresponds to the amount of the dividend paid out. This is due to the fact that the company loses value in the exact amount of the dividend because cash was given to shareholders. Options often react to this by pricing in a downward move in the stock. This is done through lower call values and higher put values. One of the most interesting options to look at when it comes to dividends is the American call option. This is because an American-style call option gives the option holder the right to purchase shares of stock at the strike price at any time at or before expiration. Most of the time, it's not a good idea to exercise an in-the-money option early, as the option holder could lose out on time value they could have received by selling the option back into the market. But in the case of a cash dividend, it may be a good idea to exercise the American call option early to collect the dividend. This scenario only works if the value of the dividend is greater than the time value left on an in-the-money American call option. Time value for an in-the-money call can be calculated by subtracting the amount by which the option is in the money by the price of the option. If the time value of the option is less than what would be received from the dividend, then the holder of the American call option would exercise before the ex-dividend date. Other corporate actions such as stock splits can also affect options. But, unlike dividends, stock splits are automatically adjusted for by giving an investor a larger number of contracts at a lower price. An example would be a call option on a stock with a strike price of $100. If the stock went through a 2-for-1 split, then the option holder would be left with 2 calls that have a strike price of $50. It should be noted that for splits that are not divisible by 1, such as a 3-for-2 split, extra contracts are not assigned as that would involve fractional options, which don't exist. Instead, the contract multiplier, which is typically 100 shares, will change along with the strike. In the case of a 3-for-2 split, the strike will adjust accordingly and the multiplier will change to 150 shares. This week, we're lucky to have Jordan Naylor, the CEO of Matrix Executions, to give more insight into how options are affected by corporate actions. Jordan has a wealth of experience in the options industry and now leads one of the most cutting-edge technology providers in the industry. I'm happy to hand off this interview to my colleague Alex, and please enjoy this week's interview with Jordan Naylor.
All right, everybody, welcome to another episode of Options Discovery. Today, I have a very special guest here, the Chief Executive Officer at Matrix Executions, Jordan Naylor. Thanks for coming on.
Hello, Alex. Thanks very much for having me. Very excited about it.
Yeah, I'm excited to have this conversation as well. It's been a long time in the making talking to Paulina at OIC, your marketing director, and just kind of getting this set up, which was awesome. And I know we have a video coming out with Alan Greenberg, the Chief Operating Officer at Matrix. So it's great to have the whole team on. So let's start off with just introduce yourself and give us a quick rundown of your educational and career path and how you got to where you are today.
Sure. Again, thank you very much for the opportunity, Alex. And for starters, as Alex mentioned, I'm Jordan Naylor, CEO at Matrix. I started in the business back in the mid '90s. I went to school at the University of Illinois at Chicago, and my fellow alumni, Alex, is interviewing me now, which is fantastic. Congrats, Alex. And I majored in finance and economics there. For me, it was a great experience, primarily because of the location of the school. So it was very close to the Loop, very close to the Chicago Financial District. So it really exposed me to some really tremendous internship opportunities. So very early on, I was able to intern at Payne Weber, worked for a big broker there and helped automate spreadsheets and, portfolio position reports for his large high net worth clients and so forth. That was a great experience. And a little bit later on, I interned for one of Tony Saliba's companies called International Trading Institute, or ITI. And that company was amazing. So basically, they trained international students on how to make markets and options. So I was able to work with some really amazing instructors, one of which is Joe Corona, who's with us today at Matrix as our Chief Strategy Officer. It's great to be, working with Joe again. But that was a great experience that really, really got me hooked on options. It just, you learn to live and breathe options going through ITI courses over and over again. So that really set me down the path of, a desire to do everything options. From there, I really started getting more on the technology side. So, development for different option trading tools. We developed auto quoters for like the Australian options market when it went electronic in '97, built volatility management programs, position management programs, and eventually built full trading systems while at Liquid Point in the 2000s. And that was another company that Tony Saliba had founded. I was there until about 2014. Then I moved on and worked at the SIBO on a next generation matching engine for a period of time. I left SIBO and started my own software company. And then a couple of years later, I rejoined forces with Tony and we launched Matrix. So that's, a little bit of a career path and education history and how I got to where I am today.
Yeah, well, super interesting. It seems like you kind of bounced around all over the place within the industry, and it's been a pretty interesting journey to hear about. So one thing I want to just kind of introduce as well is, well, what is Matrix Executions and what is your responsibilities as the CEO?
Yeah, great. Thanks for asking. So Matrix Executions is an agency-only broker-dealer. We provide execution services to institutional and broker-dealer clients, and we specialize in equity and options trading. So we have a tremendous team of highly experienced individuals that, like I learned in my early days at ITI, live and breathe options. So everybody at our company loves options. We have best-in-class technology stack. It's all developed in-house, primarily in Chicago. Most of our engineers work out of our headquarter office at the Chicago Board of Trade building. And we work very closely with clients to deliver custom solutions to meet their unique workflow needs and execution needs. So the combination of our deep experience with our staff and our amazing technology stack, we're able to, work very closely with clients to deliver customized solutions for them. Some more specifics about what our capabilities are. We obviously have robust electronic routing capabilities. We have execution algos for all different types of orders, single leg orders, complex orders, multi-leg orders, tied orders with a leg stock component as one of the legs, crossing orders where firms are committing capital and executing crosses electronically or through our floor brokerage operations. We have auto hedging capabilities, liquidity sourcing, and more, all in our electronic trading platform. We also have high-touch execution services through our box floor brokerage team, and recently launched at the beginning of this year our SIBO floor brokerage team as well, in addition to a sales trading desk that operates out of our headquarters at the Board of Trade building. And our support and coverage desk is also, operating out of our headquarters as well. So that's high level, kind of the breadth of services that we offer out to our clients and, who we are and where we are. As you mentioned, I'm the CEO at Matrix. I work very closely with all of the teams, sales, technology, operations, and others on really determining what to set our priorities to be and what the strategic direction of our firm should be based on, input from everybody. Obviously, we have input from prospects, from existing clients. We have technology challenges that need to be addressed and optimized. We have input from our operations team and our floor brokerage team. So we basically take all of that together and come to consensus on what the right direction is and form our strategic direction and move forward and execute.
Wow. Yeah, that is really interesting, and I definitely want to dive into the technology and services in the later part when we talk more about Matrix. But I appreciate the introduction and kind of giving the audience a little bit of an intro on who you are and your experiences and what Matrix does. So this episode is going to be about dividends and the effect of corporate actions essentially on options. And so let's just start it off with the pretty basic high level question, right? Whenever we see a company announces dividend, we generally think, well, if they're paying out a dividend, we're going to see some sort of drop in the stock commensurate to whatever dividend that they're paying. So, how do options prices change when a dividend is announced?
Well, yeah, so that's a very, very good question, and it's important for people who are trading options to understand this. So the one first assumption is, and this is generally true, all other things equal, on the day a stock goes ex-dividend, the stock price will drop by the amount of the dividend that was paid. Again, all things being equal, there could be news on that day, it could go in the opposite direction, so on and so forth. But so assuming that the stock drops the amount of the dividend on the ex-dividend date, basically what you'll see in the options is on the put side, you'll see relatively little change. You'll see a little bit of decay from theta, one extra day of lost, time between the day and expiration. And then you'll also, but otherwise you really won't see much in the put prices because it's really already factored in, priced in that dividend and that stock move. Now on the call side, for the out of the money calls, you'll basically see the same thing, relatively little change. It's already priced it in. But for the in the money calls, you will see a price drop by up to the amount of the dividend, depending on how deep in the money those calls are. And the main reason for that is that prior to the ex-dividend date, there was the opportunity for call owners to exercise those calls early and basically participate in that dividend. And then once you get to the ex-dividend date, that opportunity no longer exists. So that premium that was in particular, the deeper in the money calls goes away because that opportunity is no longer available.
Yeah, really interesting. And so we see that a lot with those deep in the money calls, and let's talk about also maybe the effect on the pricing of spreads. So how could a dividend potentially cause a disparity between call and put spread pricing?
That's very interesting, and that gets into some interesting structures. So I think the easiest way to start this conversation is to simplify everything. So let's start off with non-dividend paying, European style, zero interest rate environment. So in that environment, if you're looking at 5-point spreads, call spreads, put spreads, basically if you're able to buy a call spread for $2, you should be able to sell the corresponding put spread for $3. Okay. Those will both have the exact same P&L return. Their little hockey stick chart will look exactly the same. There's no interest rate involved, so it doesn't, if you're putting out $2 or collecting $3, that has no impact on it. Another way to look at that is there's a structure called a box, which is a risk-free structure, which is basically if you buy the call spread and you buy the put spread, and it's a 5-point spread, you can buy that for $5. So that's kind of fair value for that structure in this world with European options, no interest rates and no dividends, right? Zero interest rates and no dividends. Now, once you add dividends and American style options to that environment, okay, you will see boxes that can trade above $5. So basically buying that call spread and buying that put spread, the value of those two combined can exceed $5, which, kind of doesn't make sense to a certain extent. So where is that extra value coming from? Well, that extra premium is coming from that early exercise value that those call options have. And in particular, the deeper in the money call option has more early exercise value than the further out of the money call option does. So since we're buying the box, we're buying the call vertical, we're buying the put vertical. Since we're buying the call vertical, that means we're buying the more deeper in the money call and selling the further out of the money call or the higher strike call. So we're buying more of that premium. So that's why that can trade above $5. So if you go back to the first case where, hey, if I can buy this call vertical for $2, I should be able to sell this put vertical for $3. That's no longer true in that environment. And that's generally why.
Yeah, wow, really interesting, and I think that's a really good explanation on that phenomenon.
I hope you learned a little bit more about how options react to corporate actions. I also want to say a special thank you to Jordan Naylor for taking the time to talk with us. Thanks for watching, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.